Glad you could join us here with Charts and Chats with Gordon Scott. That's me. If you're here, I'm glad about that. I'm here with a guest this week, Mike Shore. So we're going to be talking to him a little bit later. Mike's a longtime options trader, and his experience is going to be really interesting for you to hear. Before we get going too much, I want to just walk you through what we typically do on a Monday morning, and that is how are the overnight markets, the over the weekend markets, shaping up in our two favorite forecasters, that is the NASDAQ and the Aussie yen. Actually, Aussie yen's on top, NASDAQ's down here. Now look at this big run up we got right here. This is all about Friday's activity from the non-farm payrolls report. Now the news came in lower than expected. So, of course, everything jumps up, right? Crazy world. What's going on is the fact that because the jobs report for US, the Bureau of Labor and Statistics, comes out saying we're not quite as many new jobs as we thought should be happening, then some people are thinking, oh, well, that could mean more stimulus or more Fed accommodative policies or something to kind of boost the markets and the economy. So therefore, let's jump in and be buyers, right? Well, as I've said before, the big thing is that people get an idea of what they want to do. And then they go looking for excuses to do it. That's kind of the way the investing behavior seems to work. And in this case, we saw a lot of evidence over the past 2 weeks of people getting less and less and less panicked and warming back up to the idea of maybe dipping a toe in and being a buyer. And here it is, right? This is like, well, maybe could we be? And then all of a sudden this news comes out and it gets interpreted as good news, favorable news for the market. So in people go. Well, now the big thing to notice, I mean, whether or not I've got that read right, that's kind of beside the point. What we really care about is what is the price doing? And what the price is doing is it jumped up and it is held. Here we are on the Aussie yen, sort of worldwide reflection of risk and risk appetite. And what are they doing? They said, okay, we like the idea of taking more risk, and they haven't given that idea up. In fact, right now, this 5-minute chart, we're up here above 84.80, and it's as close to the high from after that moment as we've seen. Now down here on the NASDAQ, the jump wasn't so quick, but buyers came in through the day on the NASDAQ and pushed prices way up. And where are we? Same thing, still holding. In fact, just within the past hour, we sort of dipped, but recovered that trend and have started on our way back up. So that's the big picture. We've got an overall bullish posture to start the week. I'm going to share my screen with you here from a particular blog entry that I found that I kind of liked, and it's got some interesting things that we should pay attention to. So here, give me a second. I'm going to share my screen, and let's see which one. That one. Okay, and hopefully what you're seeing now is my screen and this blog entry I got. This is the name of the blog, Mark to Market. It's from Mark Chandler, the chief market strategist at Bannockburn Global Forex. Now, I'm not particularly looking at this for US market data, but for just a read on how the market is responding after the jobs report. And there's some really interesting stuff here. It's a good read. In fact, let me go ahead and share that in the chat window for anybody who's curious how to get there. Just click on the link in the chat, and then you can read through the rest of it. I want to grab two pieces of data. One, Chinese exports are strong, 45 billion trade surplus, and 21% of the exports are going to the US. Okay, that's important. I'll come back to it in a second. Then there's this interesting little bit here. The dollar has been confined to a 15-tick range on either side of the Japanese yen 109.50, where a 1.25 billion option expires today, and another for around 950 million expires tomorrow. Okay, now I've seen this kind of thing in the U.S. stock market a little less so in the forex market, but the the thing that I've seen is when you have a large option position put out there, um, a market maker has to take that other side. And the market maker, when they sell an option, they don't want the market to move a lot in order to be able to, capture the premium that they sold it for, right? And so what they typically do is, they don't get directional. They like to just let the time decay of the options kind of melt away so that the money falls into their favor. But what happens when you get such a big position that it's kind of standout and that somebody like this is calling it out, then what they're noticing is, hey, if it moves, there's real risk. Somebody stands to lose, well, maybe a fraction of $1 billion, several hundred million. And so they're not going to just sit back and say, well, what's $2 or $300 million to me? No, no, no. They're going to lay off that risk. And what that means is they might sell one option and then turn around and buy different options or futures to sort of make the risk equalized. And if in fact they can't find enough of that, or if there's still some residual risk, then they'll go out there and they'll, defend the price, trying to buy it up or push it down and kind of hold it into a range if they can. Well, being able to hold the US dollar into a tight place, that would take a ton of money, probably more than the original risk of whatever the option is in that position. So I don't really expect that somebody's out there trying to manipulate the market into a tight position. Uh, However, if they sold it at a big position and took that risk, they'd have to be really smart about the fact that, well, you know, markets don't really move that much on Mondays these days, assuming we're in a low volatility situation. And we absolutely are in a low volatility situation. I'm going to show you a few charts to say about why. So whether or not the market's doing it, or you've got market manipulators, that is market makers with big positions with risk, and they have big credit accounts that they can kind of hold the market in a place like that. The reality is it's going to expire today. So people have incentive. Some people have incentive not to try to make the market move. In fact, to try to hold it in and keep, collect all that premium to whatever extent they can. So I think that what we're in for is kind of a tight range bound trading day today, because this, move on the dollar will potentially translate into other markets. However, if there is any movement, if there is any breakout, where is it going to be? Likely to the upside because of the charts that we saw before. The bullish sentiment that came from Friday has been upheld and sort of locked into place there. So that's the general read. With that in place, one of the more fundamental things that's in the markets right now, that uh, that you would expect to be influencing the markets is coronavirus data and just what's happening with post-pandemic. Are we in a recovery? I haven't in this outlet here. I haven't shown much in the way of charts there, but I'm going to just look at some simple trends of Corona charts. This is from Corona.help, and we're going to take a real simple look at things. There's just the curve of people that have gotten infections, right? So it's headed up, big surprise. But the trend is what we really care about. So here's the active cases. Look at this active case data. It's gone up, it's peaked, and it's really messy. Now, exactly why we should have such messy looking data over millions and millions of data points, because this is the entire world's, data flow over the coronavirus. Why should it be so choppy and messy? And certainly wasn't choppy and messy on the way up, but it's choppy and messy on the way down. Right? Well, ignore that for a quick second and just recognize that trend has gone up and it's definitely coming down. Now, my guess is that they keep changing the way they're counting. which is another but it doesn't matter for our purposes today. We can just say it was going up, now it's trending down. Let's look at the two nations that are driving this, the two countries. Of course, it's the United States and India. So what does the United States curve look like? We'll just zoom in on this, and you'll see that same kind of thing. Now in this one, the infection history of the curve is really beginning to flatten, and no surprise why. The active cases look like this. A couple of big data chunks taken out there. Again, probably standard change in the standard for how they're counting. And so, but either way, no matter how you look at it, it's clearly on the downward side, right? And you don't hear a lot of people really worrying about, coronavirus, second wave, third wave. I mean, there was a little bit of talk about that just a couple, 3 weeks ago, and it was mostly about India, right? I mean, at least that's where I was reading and hearing about it. So let's look at India, the number 2 country on the list right now. The curve looks really steep on the way up, but it looks like it's slowing. In fact, you look at the daily change, and that's a huge. There was this spike, but it's come all the way back down. Really strong. Active cases, same thing. Big jump up, big move down. Notice we don't have the choppy, clunky moves in the data. It's rather smooth data. Probably not a change in the way that they are counting. So, which more likely to mean that this data is reliable. So for whatever reason, India had this huge spike and has this, big retracement in cases. That's all good news, because what you see is very clear downward trends in the top 2 moves right there. So that's all good news. And what that means is people are less afraid of coronavirus becoming a serious problem. Let me run over to the stock that probably got the biggest influential bump on the whole pandemic thing a little over a year ago when this all got started. Zoom Communications, right? Where here we are in a Zoom meeting. I mean, I've been doing Zoom meetings for a long time, and webinars and so forth, and I'm sure many of you have as well. But it is really interesting just how much more online meetings and transmission through this medium and mechanism has happened as a result of the past year. Well, Zoom got a real run up because people are like, wow, everybody has to do Zoom, right? But somewhere around October, it kind of tapered off because, it was too many people were not finding anything else to invest in, and they're just investing in Zoom. And they began to think, maybe the coronavirus is going to get done. Well, now we've absolutely got data that it's done. And you would think then that Zoom would be on its way down in a big downtrend. But look at what's happening with Zoom. Huge candles, big candles coming down. A lot of sell-off back here after the March earnings. But notice how small the candles have gotten compared to what they were. I've got this line down below, which is the average true range. Look at this extreme decrease in the average true range. Now, I love to see a chart that is coming down in a downward trend, and all of a sudden, towards the bottom of the downward trend, starts to drop low in average true range. In other words, you see these tiny little candle ranges. Why do I love to see that? Well, because like most people who mess with stocks, I'm a buyer. And you want to look for stuff to buy when there's less chance of people being afraid of falling prices. That's what's happening here on Zoom. We've got earnings coming out, and they came out last week, and the earnings were, as you can see here, the estimate was 99 cents, but there were 74 cents and there were some charges, so it came out at $1.32. So basically they came out 33% higher than they expected to. So that was good news. You'd think that would make it run up, right? No. It just sort of like, so whatever it was, people didn't really find this to be particularly fascinating, but they didn't panic and sell out either. That's the big thing. Remember, people have an idea of what they want to do, and then they go looking for excuses to do it. Well, if they were really, Zoom's got nowhere to go, then that would have been the good news that everybody decided to sell on. They didn't. What happened instead was there's a little pullback and then this big move yesterday. I mean, Friday. Big, huge move, takes it up to, above recent highs on this low volatility situation. I really feel like this is an opportunity to see Zoom move higher because we just went through all that pandemic data, the coronavirus data, and it's clearly on the decline. If people think, oh, well, Zoom's only interesting because there's a pandemic and because social distancing and because work from home, blah, blah, blah. Well, if that's the only reason Zoom were interesting, then decline in pandemic trends should mean there wasn't opportunity. But I think what's happened is it's all equalized, and people realize, hey, this is actually a good company, and they've got some good forward stuff. So we're interested again. If people are interested in work from home normalizing and going forward, and we've kind of gotten rid of the hype, but it's still fundamentally a good idea, then uh, Zoom could be an interesting buy. It could also open up some interesting things for something else I'm going to be talking about here. You can see the preview on my screen. You got NVIDIA, TSM, AMD. You can guess where we're going. We're going to talk about semiconductors. But before we get there, let me bring in my guest, Mike, and let's get chatting with him. So here's the thing. I got to introduce you to Mike and why I really wanted him to come on at this time. So Mike, I met a few years ago at a conference we were both presenting at in Tampa, and I listened to his presentation and found that this guy was legit. I've been around and know a lot of people that are serious options traders, floor traders, and market makers and so forth. And in listening to Mike, you could tell he was among them. So, in fact, Mike's had a long career working in and around the options trading area and the Chicago Board of Trade. I don't know if you would label yourself, Mike, as a native Chicagoan, but he's definitely in that Chicago trading scene. And so I thought that you would really appreciate hearing some of his insights today. So, Mike, welcome to our morning market show. How are you doing today?
I'm doing great. Thanks for having me.
Oh yeah, thanks for being here for sure. So okay, what I was just starting to tell about the idea of markets kind of quieting down when they're done going down and being in sort of a low volatility mode in preparation for an upward trend. Have you ever seen sort of evidence like that yourself? I mean, is that just crazy talk, or how do you think about historical volatility, well, and implied volatility as an indicator for direction?
Uh, it's certainly I quite frankly I look more at implied volatility than I do historical, especially when you are dealing with. I think that the historical volatility probably is a little bit germane to the larger indexes to see macro trends. But if you're looking at an individual stock, definitely then as you can see, if you looked at the historical volatility of something like GME or AMC or BB, you would be, way too short everything in those names. And because why? Because it tells a story about something that it isn't anymore. AMC is not a movie theater company, at least for the next, I don't know, day or week or, who knows what it is.
Right.
But looking at historical volatility could potentially get you into a lot of trouble there. So definitely when you're seeing big swings, especially to the upside, you have to say, okay, whatever was happening before is not happening now.
Right. Right. So you've been around. How many years have you been in the floor trading game?
I got on the floor of the Chicago Board of Trade in 1994, and I was on the floor, associated with the floor for until 2013. And then 2013 is when I made my final migration off the floor and have been helping people learn how to trade. And then, of course, still trading myself.
Okay, excellent.
On the
So
screen. Yeah.
you've seen a lot of changes in that whole space over the years.
Yes.
What would you say are some of I mean, obvious people being on the floor or off the floor, that is physically.
Yeah.
but still being what we might call a floor trader, sort of a commercial trader, insider trader. Do you feel like the big changes that have happened in that physical movement have also led to a lot of changes in the way orders are processed, the way orders get done? What are the kind of things that you look at now that you didn't look at, say, 7 or 10 years ago?
Let's see. Well, one thing is that in a controlled market, I think the screens are a great thing. Ease of access. There's maybe not transparency, but their order execution is very efficient. What happens is, I'm not so sure that something like AMC would have happened. Certainly not to the extent that it did, because you have the ability, and yet, always going back to the actual physical, tangible things, where if a person is standing in the pit, there is an accountability to that. And me standing in, let's just say I'm standing next to the broker that I stand next to every day, and then suddenly I want to stop making markets in whatever we happen to be trading that day. When things do slow down, that broker, he or she is going to say, what, Mike wasn't there, and what good is he other than to be there when things are easy and wasn't there when things are bad. So you didn't see people on the floor kind of scurrying and just saying, I'm off of all this and go run, outside. You didn't see that. What you do here, if you don't like a situation, all you do is hit a button, and guess what? My markets aren't even on the screen anymore. And so you don't have that accountability, because even if you have a relationship with a broker, it's still, it's not a call around market. I don't know if you know what that means, but the price discovery is supposed to happen still on the screens in a transparent way. And but of course, the people that don't want to follow those type of rules, there's different ways around it. You can shuffle accounts around, you can do all kinds of things. So I would say that the accountability is one of the things, and just your access to the data. The reason that we stood in that, that generally uncomfortable place to stand for, hours at a time every day, wasn't because we liked that sort of thing. I mean, it was, don't get me wrong, it was interesting and fun, but it wasn't the most comfortable thing. But what it was close to the order flow. And now, just to say that the data is there for anybody. The speed of your data and everything we can argue about, but from a retailer standpoint, you definitely have the access to the market that you didn't have before. Where you would put in an order and maybe not even know for minutes, if not hours at a time, if or when you were filled. Now it's essentially instantaneous. So, but when things like huge volume spikes happen, you didn't know about that. What you knew about that on the floor is because everybody started screaming and yelling, and you'd go run over there to see what was happening. Now you at least have the ability to look at this data and scan for different volume scenarios that you're looking for. And you can see those, maybe not instantaneously. Somebody's going to be quicker to it, but you're going to be able to find out before you hear about it on a Bloomberg or a CNBC or anything like that, because they just physically can't get that story out to you fast enough. But the data's there.
Well, that's a great read. Thanks. And you mentioned AMC a couple of times. Let's bring some people up to speed that may not have heard about it.
Sure.
So over the past few months, the whole GameStop, Wall Street bets, and the Reddit community, at least this is the narrative, that a bunch of people have gotten together the idea that there are a bunch of stocks that large institutions decided they wanted to short. And because they got short on it, they got what's called naked short. So they got a whole lot of risk if the price starts going up. They got short, and people started buying these companies because they were undervalued compared to what their businesses actually were. People got short expecting that was going to go out of business, that this company was going to go under. But these clever people did a lot of math and data browsing and said, these are good companies. We should be buying them. And not only should we be buying them, we should try and encourage other people to understand the value of them. And so they did, and therefore the whole Wall Street bets thing happened. Well, the two companies that were most in the news about it were GameStop and AMC theaters, the movie chain in the U.S. So what that what that led to was this situation where if people started buying stocks and the people that were short were losing money, they had to buy the stock to get out of their short positions. And so that just made kind of a buying frenzy. And all of a sudden, price went running way up on GameStop and others. Well, recently here, so that was back here in January, and you can see on AMC, uh, this is, I got percentages on. Let me turn that to regular so you see the amounts. So AMC was down here around $1 or $2, and then all of a sudden it shoots way up to $20. But more recently, we've got AMC running way up into $60, and it's still even holding at 48 before the market opens. I'm not exactly sure what its pre-market quote is, but so AMC is crazy, and people are like, well, wait a minute, GameStop is not back up above 400, its old highs. It's certainly not 8 or 900. What's going on? Why is AMC doing this? Well, what I heard was that AMC had somebody had gone out and bought a 60,000 contract position for out of the money options, and the people that had to sell him those options then were now on the hook. And when AMC started coming up like that, then they had to get out of those positions. And weirdly enough, that sort of translated into the same kind of activity as a short squeeze. This, when it happens in the options world, is called a gamma squeeze. That's the label that gets put on it. And so I was really interested to have Mike kind of comment on this to see what's going on, because what's really interesting to me about this is, while I believe that hey, theaters, they're going to come back, probably not in the same way, but there's a lot of ways to use theater spaces that are going to get figured out, and so maybe that company's got something, but multiples of where it was already. Sure, the coronavirus is getting done. We just looked at the data, but I don't know. I don't. This seems way overvalued to me, and so I got to imagine that this is all stuff that's happening in a technical detail. And so, Mike, what's your experience about gamma squeeze, and what is the dynamic behind it, and how is it likely to play out?
Yeah, well, I mean, I guess the first thing is you don't want to be on the wrong side of one. Let's put it that way. So, let's I guess visit what would actually happen if I were a market maker in this. Now, you realize the market maker typically doesn't have a directional bias. I think that being human and being a trader, you probably do have a bit of some sort of bias to where you are now, where you think it's going to be, but that's what you're really trying to trade. You're trying to strip out all of the directional and anything else that you can, and you want to trade the implied volatility. I want to sell implied volatility high. I want to buy it low. So if somebody comes in and, for example, which I'm assuming the 60,000 lot was an out of the money call buy. So I'm going to make myself directionally neutral. I'm going to buy a certain amount of the underlying, which would be AMC stock in this case. So I'm going to buy a certain amount against it. So let's just say, at some ratio, it doesn't really matter what it is. But as the AMC stock goes up, that ratio that I intended to hedge at is going to need to be bigger. So let's just say that I had to buy 100 shares of stock where we were trading, let's just say in the low teens. Now suddenly we're trading 30. I have a lot more stock to buy. So it becomes a brinksmanship type of thing where the people that are long it know that long it meaning long gamma or long options. They know that that this hedge ratio is working in their favor. Now, are they the ones that are going to say, well, now I'm going to take some money off the table, or am I going to see how far I can push these sellers until they have to? Either from the clearinghouse is going to say, hey, Mike, you are short a lot of AMC stock here, and I see that you haven't covered it in 2 days. It was trading in the low teens, and now we're trading 47. What are you going to do about that? And I was going to say, well, I was hoping to buy it back down at 14. They're like, well, that's not happening, and we're not going to put our clearinghouse at risk because of your great idea that is not working to the tunes of millions of dollars right now. I'm not risking my clearing firm to do this. You have to come and give me a few $1,000,000 of margin, or I want you to take off however much of this position. And so, and so I'm forced to in the morning go down and say, okay, well, I said that we were going to take off half of this position or take off half of the risk, maybe even more. Maybe that, they're just like, hey, listen, we, as a clearing firm, we're at our breaking point. We're shutting you off, and we're going to cut off this risk. You can stay up here and drink coffee, or, we really don't care, because, as far as we're concerned, you're not going back down on the floor for us. So now then they have to manage the risk from that standpoint. And what do? They have to buy stock, and then they have to buy more stock. And then the collective world smells that blood, and suddenly you have something that was going from the low teens to putting in a high at 72.62. And that's where most likely the clearinghouse got flat, and then they brought it back down because there's no more buyers. The buyers were exhausted.
Yeah. That's just an options-driven way that the short squeeze, happens when with just regular shares. So that's thanks for the added color. And I mean, the clearing firm being at risk. Are we talking about Apex? I mean, or in the case of Options Clearing Corporation? I mean, who do you think are the major players here in this situation?
I mean, you're gonna have companies like companies you've never heard of. Let's put it that way. First Options, big clearing. The banks even have gotten into clearing now, and it just like everything else. It was very easy for me to identify who the clearinghouses were because they had offices where I was down trading. Just go upstairs and go to one of the clearinghouses. Now everything's cleared somewhere in what country? Probably the biggest options clearing firm is something I've never even heard of before, because it's a different game. It's most likely multinational and just big global thing. So and there's probably a lot of reinsurance that is going on where they spread off their risk amongst each other, just like any other company. They're gonna try and spread out and reduce their risk, and it's much easier to do that now because it's not a physical thing where give me Mike's trading cards from the day and we're going to see what our risk is. Now it's all instantaneous, and we're talking with people over on the other side of the globe, and somebody there could be clearing my trades, and I would know it, but I wouldn't know where to go if there was a problem. Let's put it that way.
Yeah.
Our
That's
meeting
good. That's good insight. So, Mike, but I want to be sensitive to your time, but you had said before that you help people trade right now.
Yeah.
What's the outlet that people find their way to you? Just in case anybody's curious.
Oh, thanks. Yeah, I run the short-term options, and I am also the director of education for Prosper Trading Academy. You can prospertrading.com is our website, and we run live trading rooms across all asset classes. Not all asset classes. Let me clarify that. We are we are not futures, and we are not forex. But we do talk about them still, because even if you're not trading something, the world doesn't happen in a vacuum anymore, or at least it never did. But it's much more evident now. So we provide from everything from trading ideas, open discussion for those that are not familiar with options, or maybe you're just getting into it. We have intensive trading training and things like that. So we do option volatility, we do directional options, we do stocks, we do penny stocks, and crypto now, which is a very, very popular thing.
Oh, that's interesting. You guys are doing crypto too. That's cool.
Yeah, we have a great trader out of East Coast of the United States here. I've learned a lot from it. Let's put it that way. It's great.
Yeah. Well, Mike, thanks so much. You're welcome to hang around, but as I say, I want to be sensitive to your time because I know you got to get ready for the market opening.
Yeah, I better get ready. Joe, thanks for having me. I'd love to come back, and everybody, good luck. Be wary
All
of that
right.
risk out
All right.
there.
We'll take you up on that. Thanks, Mike.
All right, awesome. Great to see you, Gordon.
So, as teased earlier, I mentioned that if the coronavirus is getting done, then there could be a big opportunity um, for a couple of reasons for the semiconductor area, the semiconductor industry. And so I want to walk through that right now. And just to kind of get a running start at it, because the coronavirus was prevalent everywhere, and they had social media or social distancing, and they shut down a variety of factories. The big thing that has really impacted society in a sort of undertone, probably bigger than anything else, is the semiconductor shortage. And that's because they got to have clean rooms. They got to have it takes months to build up a chip production factory. Intel, AMD, Taiwan Semiconductor, these companies that make chips, it's a really tightly controlled environment to make the chips in, because you're talking about tiny little spaces on the chips, and the wafers that they make them in the silicon, the way they do the etching and all this kind of stuff. It's really it's the epitome of high tech, right? And so um, if they have to shut that down, in the past, we just sort of benefit from all this consumer electronics coming through. But the reality is that it's weeks and months ahead of time that they were working their way through and building this stuff, so that by the time it lands on the shelf somewhere, or comes delivered in your Amazon box, that was months of production that ultimately brought that to you. Uh, and so when that gets shut down, now we've got this big lag. The question is, when are they going to get out of that? When is that going to come out? So you've got a company like NVIDIA, which makes the chips for graphics cards, which have up until anytime recently, and maybe it's still this way, that been the kind of major source of computing power for mining cryptocurrency. And so NVIDIA's had a lot of benefit from the cryptocurrency wave of interest and so forth. But people are a little less interested in mining now than just straight up buying Dogecoin or whatever, right? But they haven't lost interest altogether. In fact, Ethereum is becoming far more interesting as a cryptocurrency that people would stake. That is, I'm going to have cryptocurrency, and because I have it, I'm going to be part of this network. It's going to process payments and whatever else, right? So they are actually interested in trying to get computers that could take them, but you can't get them, or you haven't been able to get them for the longest time. And getting a graphics card, just trying to go online and order a graphics card. So many of them are just backdated by months, back ordered months, and you can't get it. So, but notice what's happened here. So in the NVIDIA chart, as of September last year, when it was obvious that they just couldn't sell, and everybody wanted to sell, but they couldn't, right? Here goes NVIDIA sideways. All right. And you look at advanced micro devices, similar story. I got a different chart set up, but look at that. Where are we? August, and we're flat since then. That's not because their business is bad, or it's because they just can't sell. They just can't hit the demand. You would think a company that had a bunch of demand, stock should be going through the roof. Well, it's not, because they can't make any profit from that movement. That's the problem. So Taiwan Semiconductor, Advanced Micro Devices, and NVIDIA all have something similar. Now, in the case of TSM, notice price went up and it's sort of drifted back. But generally speaking, we're in kind of that flat range. Now, August, October, all the way back there, TSM was headed up. So that's different, right? And so that's one of the reasons I'm really interested in TSM stock, because they appear to be closer to a cutting edge of being able to, like, if they're going to produce something, these people can do it, right? So here comes NVIDIA just recently with earnings, and the news was that, they had broken out of that channel, and the news was good, but people didn't start doing anything. Now, since earnings, they've been on a tear. Up it goes. I think this is a leading indicator for the rest of the industry that people are going to start buying. Companies are going to be able to slowly start increasing their production, and things are going to get back to normal. This also relates back to the Zoom situation. Zoom communications, it's like, hey, this is going to be normal business, and Zoom's going to be a part of it. It's not because Zoom's not interesting just because of coronavirus. Zoom's interesting because people use Zoom meetings, and the more business people do, the more Zoom meetings they're going to do. So anyway, NVIDIA, Zoom, these are telling me there's an opportunity ahead. So let's look at how to take advantage of this. So here's TSM, big upward trend, kind of came down. Now, everybody who's here and has been listening to me for weeks knows I was all about the, hey, doomsday thing, right? Because there were conditions that were setting up in May and they didn't transpire, right? Why didn't they? I'm going to cover that more next week about specifically what happened and what it means. But the bottom line is, if people aren't panicked and ready to go, sell the market down, it's the opposite. They're ready to become buyers. They're so interested in becoming buyers. They didn't want to panic and sell. And that means we're probably going to see a really strong bullish move between now and the end of the year. Not straight up. It's going to be choppy. There's going to be all sorts of stuff, but there's going to be lots of opportunities for big moves and big swings to the upside. And for people that do short-term trading to sort of capture those swings, that could be a real big opportunity. I think that opportunity is probably going to be most evident over the next month or two in the semiconductor space, because the whole semiconductor thing has not worked its way out yet. The constraint is in the industry because of supply. They just can't produce the chips. A lot of people want to buy them. They just can't produce them. But I think that production is going to start opening up, and you're going to start happening here. And so that's why I'm expecting the charts here to offer some opportunity. Now, when prices start moving up in a way where people, I should say it this way, when prices have moved down for a little while, as they have on Taiwan Semiconductor, and you see these big candles, and then all of a sudden you start getting smaller candles, right? If you're down at the bottom of the trend and the candles are getting smaller and options are getting cheaper, right? Mike mentioned implied volatility is what the option guys pay attention to. And if implied volatility is high, it usually means people, market makers and option buyers are worried about falling prices. That's usually what it means. Not always, but most of the time, because everybody always wants to buy call options. Everybody always thinks things are going up. It's when people start to buy put options that the ratios change, and it makes the options more expensive, because now you have not only call options in demand, you also have put options in demand. And put options are what people buy when they're worried about prices falling. So if people are buying call options and put options, and put options to a higher degree, then they're more worried about the possibility of falling prices, and you see prices move up and down, and you see implied volatilities at high levels. When they stop worrying about prices falling, then they stop buying put options, and then the prices of call options come down a little. The implied volatility on both of them drops. That is what we are seeing right here on Taiwan Semiconductor. How do I know? Well, I have this little thing here that I do on Trading View that's called IV rank, implied volatility rank. And when these lines are high, it means implied volatility is comparatively high, looking backwards over the past 6 months to a year. Right now, though, see where they are. Low, 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 low. Now, it's true, the last time they were low like this, it was, kind of hit a peak and went down from there. So it's not a strong directional forecaster to say, well, now it's going up. All it's telling us is people aren't buying a lot of put options. See right here, they weren't buying a lot of put options, but up here they were. Why? Because the price had fallen. Now the price is kind of in this level and sort of hung around, and the candle sizes are getting smaller and smaller. And so right here, people are less worried about the prices falling. That doesn't mean that they won't sell. It just means that the conditions are better for them not to sell. So if in this world people decide, I want to buy this stock, then the stock could move up kind of quickly because there just aren't a lot of sellers, there aren't a lot of panicked people that would, push the price right back down. That's kind of what we're looking at. Taiwan Semiconductor low on the implied volatility. How does NVIDIA rank as an example? Similar. See, in fact, if you look through all the semiconductors, it's kind of the same thing. Here's NVIDIA coming way up, and the implied volatility is still staying down. So that's people want to buy, and they're not worried about the prices coming right back. If I run over here and look at AMC, on the other hand, AMC goes running way up and it's coming down. Look at what its options are doing. Its options implied volatility is, I'm surprised it's not a lot higher than that, but it's up in that upper range, right? Because people are having to buy all sorts of options, worried about the possibility for it to come back down. If I go look at Intel, what do we got? Implied volatilities at their lows, right? The company I really like to watch for semiconductor movements is Applied Materials. Applied Materials isn't so much a chip maker. They are a manufacturer of chip making equipment. So if Applied Materials is doing well, it's because they're selling stuff to the chip makers. If the chip makers are buying stuff from AMAT, then the chip makers are seeing that their production needs are increasing, and they see more demand, and they're actually buying equipment. Look at what happened back here in March, when most people were selling off. AMAT started making brand new highs. So see, this is yet another clue, I believe, that the chip making industry is starting to get rolling. All right, and same thing with that company. Its options are low implied volatility, even though its prices are up near old highs. So we have people saying, I'm not worried about the fact that the prices are so high. I'm not looking to sell. I'm not worried about other people looking to sell. And so what that does is it sets the stage for the prices to just run higher. And so the opportunities that I think are most interesting are Taiwan Semiconductor and also advanced micro devices, which is low on the implied volatility. Now these lines here, these are average true range markers. So it just shows you how much these things are moving in. We're not exactly, we're just outside the range on AMD. So that's not actually, sorry, the range is the one average true range from the 20-day moving average. So if you're in this area right in here, you're kind of in an average price. AMD is in sort of above average price. Taiwan Semiconductor is, yeah, those look so similar, right? Is just barely breaking out of that average range and moving up to it. NVIDIA, on the other hand, let me bring NVIDIA into this format, is way up on the high end, way up outside of that. See, so it's like you want to stay away from stocks that have run. Well, to be truthful, I did some research on this, and I found that there is actually a statistical improvement if you buy in the first 5 days from when these hit the third or fourth lines on the upside. So if you bought here, or you bought here, either one of those is good for, holding like a month. Statistically, you have a better than average chance of that becoming higher value. Weird, huh? It's like buy high, sell higher, but that is exactly what the data shows. On the other hand, if you're past 5 days of it first hitting this, then your chances kind of come back to random. So I'm looking at this, we're way above the top. It's already been more than 5 days since it broke out of the first two upper ends. Not a good buy right now. Wait for NVIDIA to kind of dip and come back a little. On the other hand, AMD and Taiwan Semiconductor, they're both just beginning to sort of break out of the sort of normal range, and it's 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 not as strong. If in fact we were to close just a little bit higher though on either of them, then we'd be into that above that third line, into that third band, closing on the fourth, and that's the moment. See, from there you have a statistically increased chance of it being higher a month later. So it's a great swing trading opportunity. So watching for um, AMD to close above 82.50 today, or sometime here in the next 2 or 3 days. Once it does that, that's the entry signal. And uh, Taiwan Semiconductor (TSM) is going to be looks like about 120 is what we're looking for. If it closes above 120 today, next day 2 or 3, that's a good entry signal from there. If in fact you don't want to buy the shares, well, options. These would make for some great option trade. I would be looking at calendar spreads or debit spreads. That's my favorite way to do it. But because you buy call options, you got so much time value melting away. I'm the kind of person that likes to sell against that. However, if you bought a call option 3 or 4 months out and then you sold uh, further out of the money call options against it week after week, I mean, I demonstrated that. I thought we were going to be going down. I sold puts on Apple, or that is, bought puts on Apple and then sold puts against them. And even though I was completely wrong about the trade, I still made money. I still made profit from doing that. So this, you could turn around and do it the other way. You could be a buyer and you could just sell calls against it. If you're wrong and it goes down, no problem. You could still make money. But if you're right, you make a whole lot more money. So that's my favorite kind of trade, and I'm going to actually be coming back next Monday, sort of walking people through my version of the semiconductor trade and some of these option setups. So we're in looking at the Aussie yen and Nasdaq. They've sort of sold off here just in the last 10 minutes a little bit, coming in to the day. So we'll see whether or not they rebound after the markets open. And let's see, Helen had said hello and typed in a question. I want to make sure that I got the oh, okay. So Helen's asking, was going to ask about your thoughts on Aussie yen and NASDAQ correlations. So let's go ahead and bring this chart into here. If I can, there we go. Let's look at them on the screen. Aussie yen, NASDAQ. So the fact that the Aussie yen jumped, this is 15-minute chart, by the way, not 5 minutes. So yeah, the fact that the Aussie yen jumped comparatively big for, compared to its own moves on the U.S. news, the U.S. jobs report, that's kind of interesting to me. I mean, I wouldn't expect it not to move, but for it to move really big right out of the gate, right? Compared to what the NASDAQ did. Look at what the NASDAQ did. The news came out, and the news was basically bad. That is, people were expecting there should be a certain number of jobs that have been created over the past month. And they actually came out with the number, and the number was less. It was less by about 10 or 15%. So it wasn't this huge mess, but it was less. And so historically, that means, okay, that just means the economy is in the U.S. is not going to be rolling forward as fast. And yet there's this sort of second and third layer of people's expectations. Well, in this case, the fact that that candle is not that big, you would usually expect this candle to be 4 or 5 times as big as the average candle leading up to it. And it looks maybe 2 or 3, not 4 or 5. You'd expect a candle that size plus some, shadows on either side of it. Didn't happen. It was a small candle, right? That was a small candle for the futures, but this was a very big candle for the Aussie yen. What does that mean? Well, that means global investors were a lot more interested in taking on risk, hunting for opportunity after the news, than US investors were. So either these guys paid too much or these guys didn't pay enough. Somebody is off track a little, right? And because these two things stay fairly correlated, you can always expect that if one of them jumps out from the other, that they're going to come back in line somehow. In this case, it was the fact that the Nasdaq caught up to the Aussie yen. So here goes the Aussie yen, and it continues up for the next, these are 15-minute charts, so it's a total of an hour, and this is an hour and a half before the market opens, before the U.S. market opens. And so then, or 1 hour, is that right? It's 8:30, 9:30 is when it opens. Yeah. So this is the market open right here. So this thing comes out, and then by the time the U.S. market opens, it's going to come back a little. Why? Well, because this one shot out in front and this one was behind, but this one catches up. See that dynamic? This one comes back, this one catches up, and then they kind of sync up. By this point in time, 10:30, which is right around here, then they're kind of together, and then they just go more or less similar from there, right? That's an example of a trading opportunity. If you saw this thing come running up and you see, hey, this hasn't caught up to it yet, then you knew, if you weren't in the trade, that you could fade that trade once it was done. And sure enough, that's what happened. And Aussie yen, what are you talking about? 84.761 to 84.57. You got about a 20 pip move you could get right there from that fade. That's interesting. Or if you're not the kind of person that likes to do that, it fades back, and when it kind of settles, notice that you didn't see the NASDAQ come dropping back down. In fact, what you saw was it holding, right? So if this drops and then this comes right back up like that, and the NASDAQ doesn't even move at all through this whole bit, what is that telling you? That tells you I'm on an upward trend, likely to continue, then I can catch this rebound. And this isn't the biggest move in the world, but if you had a high degree of certainty, I'm buying here, I can set my stop there. 1 for 1, I take my profit right up in that range. Boom, easy trade, right? So that's just an example of how you can play the correlation, especially over big news events, between the Aussie dollar and the NASDAQ futures. And you can get that data right there on TradingView if you don't have access to it anywhere else. So hope that was a useful guide for you, Helen, to sort of talk that over. And yeah, such a big move on hardly bad news, moving right direction. Anyways, yeah. So, oh, good. Yeah, thanks, she says. So we're a couple of minutes away from the market open, and I expect it to be a quiet but mildly bullish day in the trading area. Let's take a look at the USD JPY. So the dollar yen, if the markets are going up and the Aussie yen is going up, the Australian against the yen, then you would probably expect the US dollar yen to be going up, wouldn't you? Because it's on the other side of the yen. Well, but it's not. The US dollar is dropping lower against the yen. That's interesting to me. No, but that's still a continuation of the trend. See, that same move was bad for the dollar, kind of dropped there, right? And if the dollar goes down, then things you buy with the dollar go up. U.S. stocks are something you buy with U.S. dollars. So if the dollar goes down, it tends to push the market higher. Not always, but clearly that trend is at play here. Notice what's happening as we're coming into the opening of the U.S. market. Dollar is sliding further and further. That's interesting. While we've got the NASDAQ dropping down, I think that the fact that the dollar keeps sliding, at some point, people are going to say, we've got to be buying stocks to protect ourselves from a falling dollar, or just recognize that cheaper dollar means more expensive stocks. So either way, I think that that is a bullish look for the U.S. markets once they kind of get over the idea that it might mean U.S. market is weakening. But all the more reason you would be interested in looking at Taiwan Semiconductor. So there we are, because it's a chip maker that's not a U.S. chip maker, right? All right. Anyway, there's Taiwan Semiconductor opening right here at that level, right at 117, 118. So watch for it if, in fact, it makes it to 120. A move at 120 could mean that we could be looking for 120 to 130 anytime in the next 2 weeks to follow. Back over to the Nasdaq. Let's go a 5-minute chart here now that we're open. US dollar yen and the Nasdaq. Okay, there it is. And so there's the opening candle right there, is not? No, that is a delayed, it looks like, because that's only given us 920. So here's the 930, actually dollar moving up to see the US markets. Yeah, that's the dollar. And this is the Nasdaq, but it's like 10 or 15 minutes behind. For some reason I thought we were closer to it than that. In any event, I think that what we're after is going to see more opportunity to come. Oh yeah, a little bit of selling happening. Let's come back just to SPY. There we go. So opening really tight, really quiet. Opened, didn't move very much. Down a little bit on the S&P 500, but like I said, I think it should be quiet. I think we should see a little bit of drift higher throughout the day. We'll see how it goes. Next week, we come back. I'll be talking about what it means for the markets not to have crashed and why that might be a bullish setup for the weeks and months going forward, and how to play it. We'll be looking at that next week on Charts and Chats with Gordon Scott, CMT. Until then, take care.